Most investors think capital gains tax is just part of life. You sell a rental, you cash out of stock, maybe you exit a business, and boom, a portion of your profit goes straight to the IRS. But what if, instead of watching a big piece of your gain disappear, you could delay that bill, reduce it, and potentially eliminate tax on the future growth of your new investment? That's exactly what opportunity zones allow you to do. And honestly, most people don't hear about this strategy until long after their window has closed. So today, we're going to walk through exactly how opportunity zones work, who they're a fit for, what deadlines actually matter, and how sophisticated investors build them into a long-term real estate and tax plan. We'll go step by step, the same way we explain it to clients, so you walk away with real clarity, not confusion. What opportunity zones really are. All right, let's start at the beginning. Opportunity zones are specific areas identified by the government as needing development, places where new housing, businesses, or infrastructure would meaningfully boost the community. But here's the part most people miss. Simply buying a property inside one of these areas does not give you tax benefits. You only unlock the tax advantages if you invest your capital gains through something called a Qualified Opportunity Fund, or QOF. That fund must follow strict rules, invest inside approved zones, and meet ongoing compliance tests. The flow looks like this. You sell something, you take the gain, you invest that gain into a QOF. The fund invests in opportunity zone property or businesses, and that unlocks the tax incentives, the three major tax benefits investors care about. Now moving on, let's break down why opportunity zones get so much attention. 1. You can defer your capital gains tax. Instead of writing a huge check this year, you push that tax into the future. This frees up capital and boosts cash flow when you need it most. 2. You may reduce the taxable amount of the original gain. Depending on the rules in effect and your holding period, you may shrink the portion of the gain that's eventually taxed. 3. Tax-free growth on the new investment if you hold long enough. This is the real wow moment for most investors. If your opportunity zone investment appreciates and you meet the long-term holding requirements, that new appreciation can be fully tax-free when you exit. Let that sink in. You can turn a one-time taxable gain into a long-term, tax-free growth engine. That combination is rare in the tax code, and it's why serious investors pay attention. The 180-day clock, the opportunity zone deadline that can't be missed. Opportunity zones are powerful, but they're strict, and nothing is stricter than the timeline. You have 180 days from the day you recognize your gain to roll it into a qualified opportunity fund. If you miss that window, the opportunity is gone. There is no fix and no workaround. Now, here's a nuance many investors don't know. If your gain came from an S-corp or partnership, your 180-day clock may start on the day the partnership realized the gain, the last day of the partnership's tax year, or the day your return is due. That flexibility can save a deal or break it, depending on how early you talk to your advisor. We've seen so many people reach out months after selling stock or real estate, hoping they can still roll the gain into an opportunity zone. What gains actually qualify for opportunity zones? Let's keep going. Only capital gains qualify. This includes gains from selling real estate, selling stocks, selling crypto, selling a business interest, selling artwork or collectibles, selling partnership or LLC interests. You only roll the gain, not the full proceeds. That flexibility makes opportunity zones far easier to implement than many other tax strategies. What qualified opportunity funds invest in? Inside the fund, your capital generally flows into new construction, heavy value add or full rehab projects, qualified local businesses, mixed-use developments, workforce housing initiatives. Because of these rules, most people don't create their own fund. A real-life example you can visualize. Let's say you sold a rental property and recognized a $450,000 gain. Normally, you'd owe a pretty painful tax bill that same year. Instead, you reinvest that $450,000 gain into a qualified opportunity fund within the 180-day window. The fund then develops a mid-sized multifamily building in an opportunity zone. Fast forward a few years, the project stabilizes and grows in value. Your investment is now worth $800,000. Your original gain is deferred and eventually taxed according to the rules. But the $350,000 of appreciation inside the QOF, if you hold long enough, that growth can be fully tax-free. That's the part that changes the math for long-term investors. The most common opportunity zone mistakes. Let's take a moment to walk through mistakes we see all the time. Missing the 180-day reinvestment deadline. Assuming buying property in a zone is enough investing in a fund that won't stay compliant. Not understanding which gains actually qualify. Relying on OZ benefits to make a weak project look good. Opportunity zones can be transformative, but only when structured properly. How opportunity zones fit into a bigger tax strategy? Opportunity zones should never stand alone. Smart investors integrate them with strategies like cost segregation inside OZ projects, bonus depreciation for early cash flow, strategic entity structuring, long-term estate planning, mapping exits with 1031 exchanges. The best returns happen when OZ planning aligns with your broader investment goals: cash flow, appreciation, legacy, and risk tolerance. Why work with a specialized tax advisor? General tax preparers know how to file a return, but opportunity zone planning requires capital gains analysis, multi-year forecasting, fund due diligence, IRS compliance rules, real estate structuring, entity planning, associated depreciation strategies. At GavTax Advisory Services, we help investors analyze their gains, evaluate QOF options, model tax outcomes, coordinate with legal teams, and prepare audit-ready documentation. It's not just about getting the deduction, it's about protecting it. Your next steps. If you're sitting on or expecting a meaningful capital gain, here's what we recommend. 1. Talk to your tax advisor before the sale. 2. Decide whether opportunity zones match your timeline and risk profile. 3. Vet qualified opportunity funds carefully. 4. Model your numbers both ways, with OZ and without OZ. 5. Integrate OZ planning with your long-term tax and real estate strategy. Opportunity zones give investors one of the few pathways to transform a large tax bill into long-term tax-free growth, but only with planning and proper structure. If you want clarity on whether opportunity zone investing is right for your situation, visit GavTax.com to schedule a consultation. We'll walk you through the rules, avoid the traps, and help you make a confident, fully informed decision. See you in the next video.